This is the review for the second quiz, and essentially it will cover the material which we've done since the first quiz. Simply put, these are the three skill sets I'd like you to be able to bring into the quiz. The first is whether you can compute the cost of capital for a project, not just for a firm, and that requires estimating a cost of equity and deciding what debt ratio to use on a project. The second is to come up with the cash flows and investment. So you have to understand the difference between earnings and cash flows, the difference between firm and equity cash flows, how depreciation affects your cash flows, and why we care about working capital. You also have to understand the difference between something that's incremental and something that's not, why it plays out. And finally, you got to be able to convert the cash flows you have into a measure of time-weighted return. NPV or IRR if you're looking at a standalone project. But if you're comparing across projects, can you compare net present values across projects with different risk and different lifetimes? So quite a few things to go. Let's start with cash flows. The cash flow for a project or for a business can be estimated in one of two ways. It can be estimated before debt payments, and that's called cash flow to the firm. So it's a pre-debt cash flow, or it can be estimated after debt payments, interest payments and principal payments, and that's called cash flow to equity. Why does it matter? Well, the discount rate you use is going to be different depending on how the cash flow is computed. As to how the cash flow is actually computed, it's a three-step process. You start with accounting earnings, and whether it's net income or operating income will depend on whether you're doing equity cash flows or firm cash flows. You add back depreciation and non-cash charges. Why? Because they're accounting expenses that lowered your income. You subtract out capital expenditures if you have any. And if you have a project, it might be that you don't have any once you've made that initial investment. And then you subtract out change in working capital. To get to cash flows to equity, you have one additional step. You have debt repayments. You got to show those cash flows as well. And you can get to cash flows to equity. So let's take a simple example. From a few quizzes ago, it's an investment that Nova Chemicals is making. The initial investment is $250 million. You're given revenues, depreciation, and operating income for the next 3 years. And you're given the three line items: depreciation, other operating expenses, and allocated G&A. So I've given you the pre-tax operating income each year for the next 3 years. Then I throw a curve at you. I say in this particular problem that all of the allocated G&A cost is fixed, and that you will have to invest 10% of the expected revenue each year in working capital at the start of the year. The key word, the start of the year, that's going to affect the timing of the working capital. At the end of 3 years, you expect to get the remaining book value back of both your initial investment and any working capital you've invested over that period. It says estimate the expected after-tax cash flows. Notice I'm not asking you to estimate a net present value yet, just estimate the after-tax cash flows assuming a 40% marginal tax rate. So let's get started. In year 0, which is really time 0, you have your initial investment, $250 million. Your revenues are given in the problem. You subtract out the depreciation on your initial on the investment, which is going to be 75, 50, and 25, also given in the problem. You subtract out other operating expenses. But remember, you were told the allocated G&A is all fixed. It's nothing to do with the project, so set it to 0. The pre-tax operating income you now have is really the incremental pre-tax operating income in this project. You apply the 40% tax rate to it, you get an after-tax operating income. Then you add back the depreciation, because remember, it's a non-cash expense. And here's where the twist in this problem comes about. There's a working capital that changes each year as a percent of revenues. It's 10% of revenues. 10% of year 1 is $22.5 million. I showed in year 0. You're saying why? Remember that the investment in working capital happens at the start of the year. The start of year 1 is actually right now, so I'm showing it in year 0. Now what happens in year 2? My working capital goes to 10% of 300, which is 30 million. You're saying, why isn't 30 million showing up? Well, because I've already got 22.5 million invested. I just show the change in working capital, which is 7.5 million in year 1. Then you get to year 2. I take the change in working capital from year to year 3, which is 15, and show that as a cash flow. So you go 22, 22.5, 7.5, and 15. Collectively, you've invested $45 million in working capital. Now, what happens at the end of year 3? You wrap up the project. You get your salvage value and your equipment back, which is $50 million. You also get the working capital back because that stayed in the problem. So your cash flows in year 3 are augmented by those two cash inflows. I've got my cash flows every year. Now, as you look at this problem, here's, think about how working capital plays out. It's just the change in working capital that affects your cash flows. We'll come back and do another problem with working capital, but that's a very simple example of cash flows. Now, once you get the cash flows, of course, the next step is computing a net present value. The net present value should be the discount rate used to get the net present value should first reflect the type of cash flows you have. If they're cash flows after debt payments, your discount rate should be a cost of equity. If they're before debt payments, it should be a cost of capital. Now, when you look at project net present value, so the discount rate should reflect the risk of the project, not the risk of the company looking at the project. We always look the beta. So remember the case, we looked at the beta for the project, not the beta for the company looking at the project. And remember again, if you have a currency choice, that should also play out in your discount rate. So discount rates are all about being consistent. There's no one number that's right. It depends on how you estimate the cash flows. So let's take an example for net present value. This is a project where a company is planning to invest in a new telecom investment. The initial investment is expected to cost 60 million. The project is expected to generate income for the next 10 years, and you're given the annual number. So every year you're going to get the same income. So I've given you revenues minus operating expenses minus depreciation. I come up with earnings before interest and taxes. At least in the statement I've given you, I subtract out interest expenses, come up with earnings before taxes, subtract taxes, I come up with net income. At the end of the 10th year, the project is expected to end. You will be able to collect the remaining book value as salvage value. What's the remaining book value? Remember, I've given you the initial investment in this project is 60 million. And I've also told you that the depreciation each year for the next 10 years is going to be 5 million a piece. So at the end of the 10th year, you're going to have 10 million left over. That's going to be salvage. The cost of capital for the company is 9%, but this project is in a riskier business with a cost of capital of 12%. Two things to remember here. One is you got to be careful about which discount rate you use. Since these cash flows are in the riskier business, you have to use the 12% cost of capital. It's matched up to the risk of the project. The second is I've given you cost of capital, not cost of equity. And the statement that I've shown you gives you net income on the project, which is an equity income. So here's the first thing I do. I redo the income statement and try to compute an after-tax cash flow to the firm. So I start with revenues. I subtract operating expenses and depreciation just like I did before. But now I apply a tax rate directly on the operating income. I know you have interest expenses, but act like you don't. You come up with an after-tax operating income. You add back the depreciation. You got your cash flows every year of 9.9 million. So in this case, we're ready to do the problem. Your initial investment is going to be $60 million. Your after-tax cash flows every year are going to be $9.9 million. At the end of the 10th year, you get your salvage value back. You take the present value of those cash flows using the 12%, the higher discount rate because it's a riskier project. And don't forget the salvage value at the end. The net present value that you get is minus 0.84. It's a slightly negative net present value project. So the key thing to take away from that particular analysis is the distinction between equity income and operating income and how I work to get cash flows before debt payments. And the second is making sure you match up the discount rate correctly so that you're using the project's risk to assess the discount rate. Now let's talk a little bit about cost of capital for a project. It's a very quick review because we've kind of established the principle. Let's lay it out. The beta that you should be using to come up with the cost of equity for a project should reflect the beta that the project is in, not the beta that the company looking at the project is in, perhaps by looking at traded firms in the same business as the project. For the cost of debt and debt ratio, the problem is to be pretty specific. If the project is a standalone project, a project that can stand on its two legs and actually borrow for itself, it might have its own debt ratio and cost of debt. But if you're part of a bigger company, you got to be careful that you don't end up using how the project is funded to give the project a subsidy. Let me explain. Let's assume that a mature company with a really great access to debt goes out and takes a project by borrowing 90% of the money it needs to take the project. Before you use a 90% debt ratio in your cost of capital, remember the company is able to borrow this much only because it has debt capacity. It's developed this great rating over time. If you use that 90% debt ratio and use a really low cost of debt, you're effectively pushing down the cost of capital for this project and effectively also subsidizing the project. So what should you do? If it's not a standalone project, I would use the company's target debt ratio, perhaps the debt ratio of the sector in which the project is in, rather than how the project is actually funded. So let's try another example. It's a project of that a bookstore, a publishing company, which is considering expanding into educational services. Let's assume that's a different business. Solitaire books is a levered beta of 0.80 and a debt to cap ratio of 20%. The unlevered beta for educational service companies is 1.10, and Solitaire plans to use its existing debt ratio in funding the business. Solitaire's effective tax rate is 30%, but the marginal tax rate is 40%. Solitaire is rated single A, and the default spread for single A rated companies is 2%. Estimate the cost of capital you would use in doing the project analysis for this investment. That's all. No net present value, just the cost of capital. And you're told the risk-free rate is 3% and the equity risk premium is 6%. Let's see what we're given. We're given the unlevered beta for the educational services companies, which is what we're going to use as a starting point. You're told that the debt ratio that Solitaire uses in this particular venture is the same debt ratio that is elsewhere in the business, which is going to be 80% equity, 20% debt, and that Solitaire can borrow money at a cost of debt that is 2% higher than the risk-free rate. In this case, if you had 2% of the risk-free rate of 3%, you get a cost of borrowing of 5%. Now here's the key question. When you compute the after-tax cost of debt, are you going to use the effective tax rate or the marginal tax rate? And if you remember our discussion in class, while you might have differences on this when you're computing taxes on income, on overall income, when you do cost of debt, the answer is a slam dunk. It's always the marginal tax rate because interest saves you taxes on your last dollar of income. We're ready to do this calculation. Let's work it out. We start with the unlevered beta for educational services, 1.1, but remember the beta that you use to get a cost of equity is always a levered beta. I use the debt to equity ratio of existing businesses. Remember, we're at $20 of debt for every $80 of equity. Remember, when you do debt to equity, not to use the debt to cap as a shortcut. It doesn't work. So if your debt to cap is 20% debt, 80% equity, your debt to equity is 20 divided by 80, which is 25%. The marginal tax rate is 40%. The levered beta that I'd use for educational services, taking the unlevered beta and using the debt to equity ratio and the tax rate is 1.265. To get my cost of equity, I use that beta in conjunction with the risk-free rate and the equity risk premium. I come up with 10.59%. You're given the information for the pre-tax cost of debt. Default spread of 2% over the risk-free rate, you get 5%. The after-tax cost basis with a marginal tax rate of 40%, my after-tax cost of debt is 3%. My overall cost of capital is my cost of equity. And now we revert back to the old debt to cap ratio, 0.8, plus the cost of debt after tax is 3% times 0.2, gives me a cost of capital for this project of 9.07%. So the key for looking at cost of capital for projects, you have to focus on the project, not the company taking the project. So let's do a checklist on earnings versus cash flows. First, once you computed earnings, the first thing you're checking is, are there any non-cash charges that are treated as accounting expenses? Depreciation and amortization may be the most common, but they're not the only ones. Second, are there any cash outflows that are being ignored? And the answer is, of course. Your capital expenditure is a cash outflow, but you're ignoring it because you're so focused on computing accounting income. And third, you need to adjust accrual income to cash income, and that's what the change in working capital does. There are three different ways in which you can get after-tax incremental cash flows in a project. I'm going to go through all three. You don't have to know all three, but pick the one you're most comfortable with and find at least one other approach that you can use because you want to double-check your answers. So this is a really long and involved problem from a few quizzes ago where Reader's Digest has completed market testing that there's a market for a CD. So to show you how old the problem is, Reader's Digest is actually planning on putting CDs in envelopes and mailing them to you. But as I said, at the time it seemed to make sense. The market testing cost is $5 million, which has already been spent, but will be capitalized and depreciated straight line over the next 4 years. This is going to create a mess for us, but we've got to deal with it. Reader's Digest will have to invest $25 million in new computers, CD-ROM drives, there you go again, throwback in time, and other equipment. The equipment will have a life of 4 years, and the end of which the salvage value is $5 million. During the 4-year period, you're going to use straight line depreciation, which makes your life simpler. In terms of additional information, it's estimated that 300,000 CD-ROMs will be sold each year for the next 4 years at a price of $50 per CD-ROM. God, what's on those CD-ROMs? Hey, but take my numbers as given. 300,000 times 50 is going to become your total revenue. The cost of producing and packaging each CD is going to be $10. That's going to be your operating expense. There'll be 10 full-time employees, and the payroll for these employees is expected to be $2 million a year for the next 4 years. Notice how I'm keeping things even across time. That's to make your life easy. So when you do year one's cash flows, you can use them for all 4. That's why I stick with straight line depreciation in so many of these problems. The firm will have to maintain an inventory of 10% of revenues, and that investment will have to be made at the beginning of each year. We talked about an earlier problem where we did this, and you saw it show up in the timing. But the entire working capital can be salvaged at the end of the 4th year. The total advertising budget for Reader's Digest right now is $25 million, but if it gets into this new project, that advertising budget is going to increase to $27.5 million. So you can already see the incremental advertising expense is going to be $2.5 million. I throw a twist in here. I said the accountants, for whatever reason, have decided to allocate 5% of the total expense rather than use that incremental amount. Why take something direct when you can do something indirect? But go figure, accountants. The firm has a tax rate of 40%. So let's see the first way in which we can compute cash flows. Let's start by doing the income statement. And this is a conventional income statement. Your total revenues are number of CDs times the CD price of 15 million. Your production cost is 3 million. Your payroll is 2 million. The depreciation is going to be the 6.25 million, and it's composed of 2 parts. 1.25 million of that is the depreciation on my original sunk the investment I'd made as market testing. I'm writing it off over 4 years. So 1.25 million is that depreciation. The other 5 million is coming from the new investment of 20 million that I'm depreciating over 4 years. So 5 plus 1.25 is 6.25 million. Remember, the accountants had that crazy scheme to allocate advertising. I take 27.5 and I allocate 5% to the advertising. I'm thinking like an accountant all the way through the statement. So that's why I'm going with the accounting numbers. You net out all those expenses from the revenues. You come up with operating income of 2.375 million. 40% of that is taxes. That's 950,000. I subtract that out. My after-tax operating income, if I follow the accounting rules, is 1.425 million. So here's the first way to get cash flows. Don't even start with the accounting income statement. Just go directly to the cash flows and focus directly on the incremental items, not the total items. You're saying, what are you talking about? Rather than start with the operating income you saw on the previous page, I'm going to do an entirely different operating income page based only on the incremental items. If you're wondering what that is, just hang in there. You're going to see. I'm going to start with the revenues, 15 million like before. My production costs and payroll are exactly what they were before, 3 million and 2 million. Now you're saying, why is my depreciation lower by 1.25 million? Remember, these are incremental cash flows. That 1.25 million of depreciation, which you'll have on the original test marketing, is going to be there anyway, whether you take this project or not. Remember the 2 questions you asked. What will happen if I take the project? What will happen if I don't take the project? The 1.25 million is there anyway, so I take it out of the process saying it's not incremental, which leaves me with just the incremental depreciation. And because I'm doing everything in incremental terms, I'm not going to go with the accounting allocation. I'm just going to take the incremental expense, 27.5 minus 25, and show it as incremental advertising. Much cleaner way to do income statements. I get an incremental operating income of 2.5 million. I net out my taxes at 40%. I come up with after-tax incremental operating income of 1.5 million. I add back the 5 million in depreciation. My after-tax cash flow is 6.25 million. This is a pre-debt cash flow, so I would discount the cost of capital. But this is, for me, this is what works best. I find it easiest to work with just incremental items and come up with an incremental after-tax cash flow. For those of you who prefer the accounting route, you can get to the same answer starting with the operating income after taxes. So if you go back to the original income statement, remember my accountant computed an operating income after tax of 1.425 million. I start with that. I add back the entire 6.25 million, even though 1.25 million of that is non-sunk. It's a non-cash charge, and whether it's sunk or not, I should be adding back. I come up with cash flow, an intermediate stop of 7.675 million. And then I've got to clean up for 2 items. The first is that 1.25 million in depreciation that I allowed the accountant to treat as depreciation should never be included. What effect does that have on the cash flows? Remember, the effect of depreciation is the tax benefit from it. In this case, 40% of 1.25 million is 500,000. Right now, I'm counting that tax saving as part of my cash flow, but I'm going to get that tax saving anyway. So I subtract out the tax benefits from that sunk depreciation. I also looked at at an allocated G&A expense of 1.375 million, which was lower than my actual incremental G&A. So it's actually the reverse of what you saw in the Disney case, where I under allocated. Here I've over allocated the expense. So I subtract out what I should not have allocated. So basically I take, in this case, I subtract out the additional amount I need to bring in here. And that additional amount here is 6.675,000. Here's how I come up with it. Remember, the incremental advertising is 2.5 million, and I counted only 1.375 million. I take the difference and multiply by 1 minus t. Why 1 minus t? Advertising is tax deductible. If I subtract out those two items from my after tax to get to my after tax cash flow, I get exactly the same cash flow I had before. So you can get from accounting income to cash flows, but you can see why I'm a little leery of this approach, because it's so easy to screw up. In this case, for instance, to get my cash flow and depreciation, I had to multiply the depreciation by the tax rate. But to get the advertising effect, I had to multiply by 1 minus t. After a while, you're going to be confused. When do I multiply by t? When do I multiply by 1 minus t? If you don't like playing that game, go back and do it the first approach with just incremental cash flows. So let's focus in on the effect of depreciation. Depreciation by itself doesn't do much for me. It lowers my operating income and I add it back. But the reason it makes a difference is it does affect my taxes. In fact, if you are ever given a problem with just the depreciation changing, you don't have to redo the problem, because when depreciation changes, the only effect it has is the tax effect. And the tax effect is going to be the tax rate times the depreciation. So with a traditional income statement, you add back the entire depreciation, the tax effect is already in. But there's a third way in which you can do cash flows, where you actually keep this tax effect separate. So we've done two ways already. Here's the third way. This is a pure cash flow statement. I start with revenues, but I subtract out only the cash expenses, the production costs and the payroll. Notice that depreciation is gone. It's non-cash expense. Then I subtract out incremental advertising, which is a cash expense. I come up with a before tax cash flow of 7.5 million. Then I subtract the taxes I would pay on this, and I subtract the $1 million. I come up with an after tax cash flow of 6.5 million. Sounds magical, right? You're saying, where's the depreciation? Here's where it showed up. Notice my before tax cash flow is 7.5 million. To compute my taxes, here's what I had to do. I had to subtract out the 5 million in incremental depreciation, which gives me 2.5 million. Multiply that by 40%. To come up with the 1 million, you subtract the cash taxes, you come up with cash flows. It looks simpler because it looks like I'm just doing cash flows, but you still have to deal with depreciation. There's no way around it. So try all three, see which one works for you. For me, the incremental income and adjusting for cash flows tends to be easiest, but for you, something else might work. As I said, it's nice to have two different ways. You can check the answer. Finally, let's talk about working capital. The effect of working capital comes about because it ties up cash. So when you have working capital in a project, here are the three basic questions you need to ask. First is, do I need any initial working capital to get started? Because that's going to show up in time zero as part of my initial investment. Second, how much does my working capital change over the life of the project? Because remember, it's only the change in working capital that affects your cash flows. If your working capital increases from year 1 to 2, you got to show the change in working capital as a negative cash flow in year 2. If it decreases from year 2 to 3, you got to show it as a positive cash flow. And finally, if the project ends, you have a finite life project, don't leave your working capital hanging out there. You got to tell me what you plan to do with that working capital. And most of the time, the easiest way to deal with working capital is salvage the entire amount. That way you don't have to deal with taxes or any other side issues. So in the Reader's Digest case, there is working capital. It is 10% of revenue. So it's made at the start of the year. So if you look at my initial investment, you got a $1.5 million working capital investment. That's a 10% of revenues in year 1. You're saying, why isn't there working capital after year 1? Remember, my revenues are flat after year 1. They're 25 million a year. And my working capital stays at 1.5 million a year. There is no change in working capital in years 1, 2, 3. And then you get to the end of year 4. If you look at my salvage value, it's 6.5 million. It's composed of two pieces. One is the 5 million that you got as your salvage on the initial investment. The other is the 1.5 million in working capital that you're collecting. So if you're wondering why there are no working capital investments in the intermediate years, it's because there's no change. It's only when there's change in working capital that you'll see the cash flow effect every year. You're saying, what if I don't want to salvage working capital? That's fine. You can show 5 million as your salvage value. Then you better do something about the tax write-off you're going to get because you threw out 1.5 million in working capital. And then I asked, would your analysis be different if you'd assumed an infinite life? If this brings back bad memories, this is, of course, what you did in the case. Here's what you cannot do. You cannot get to the end of year 5 and assume you can make $6.5 million in cash flows in perpetuity. Why? It's going to be impossible. 5 million of that is depreciation. There'll be nothing left to depreciate. So you have to bring in some capital maintenance to get this project to be a forever project. And remember, the simple rule of thumb for capital maintenance is you bring in a capital maintenance equal to your depreciation if you want to keep your cash flows fixed. So in this case, every year from the after-tax cash flow 6.5 million, I'd be subtracting out 5 million to come up with the cash flow 1.5 million every year for the next 4 years. And then beyond the 4th year, I'm going to have a perpetuity of 1.5 million, which will give me a much higher terminal value. I'm not even sure it'll give you a higher net present value today because I'm trading off. I'm trading off lower cash flows for the next 4 years for a much bigger number at the end of the 4th year. Finally, let's talk a little bit about the incremental test. Remember, the 2 questions you were asked is, what will happen if I take the project? What will happen if I don't take the project? If the answer is the same to both questions, the item is not incremental. If it's different, then you have an incremental item. You got to bring it into the analysis. About the time weighting, it's a fancy word for discounting. So when you think about discounting cash flows, you're basically time weighting the cash flows. And remember, there are 2 ways you can compute a time-weighted return. One is the net present value, where you discount cash flows back at a cost of capital and come up with the net present value today, including the initial investment. And the rule there, if it's greater than 0, it's good. If it's less than 0, it's bad. The other is the internal rate of return. I'm going to let you off the hook on this one. On the quiz, I will not ask you to compute an IRR because here's what it tends to do. It tends to separate people who've learned how to use the IRR button on their calculators from those who have not. But you should know how to compute IRR, even if you don't have a calculator. I'm not going to test you, but the process is trial and error, or you can draw a net present value profile. Finally, let's talk about choosing between projects. If you have 2 mutually exclusive projects with the same life, then it's simple. Pick the one with the higher net present value. If you're capital rationed, you might pick the higher internal rate of return. It's when projects have different lives that things get messy because the longer life project is going to have a higher net present value simply because it has more cash flows. So there are 2 ways you can get around it. One is to replicate the projects until they have the same life, which is going to be a problem if I gave you a 9-year project and a 13-year project. The other is to convert your net present value, which is a lump sum today, into an equivalent annuity and essentially compare those annuities. Again, let's take an example, and this is from a few quizzes ago. We have 2 choices in terms of long-term contracts. The first is the US government has offered you a 3-year fixed contract where you will receive $60,000 next year, $70,000 the year after, $75,000 at the end of the 3rd year. It's a guaranteed contract. The second is to the software company where you do apps, but you're going to get a percentage of the net profit. The expected net profits are going to be $200,000 next year, grow $50,000 a year for the next 4 years. So 2 different contracts. If you take one, you can't take the other. And potentially 2 different risks, and you're going to see why. The risk-free rate here is 3%, but the beta for software companies is 1.20, and the equity risk premium is 5%. So let's take the first contract. 3 years of guaranteed cash flows, guaranteed by the government. Guess what you should discount these cash flows at? At a risk-free rate. And if I take the present value of the cash flows at my 3% risk-free rate, I get a present value of $192.9 billion. On my second project, I come in and look at 5 years of cash flows. I take my share and I discount them back because this is an equity share, because you're taking a share of net profits. The key word is net profits. I discount them back at the cost of equity. Risk-free rate plus beta times risk premium. A 9% cost of equity, I get a net present value of $227,000. Now, if I just compare net present values, the second project looks better than the first one. But remember, the second project is a 5-year project. The first one is a 3-year project. Now, of course, you can replicate these projects to be 15 years. So the first project 5 times, the second project 3 times. What a pain in the neck, though. So I'm going to take a simpler route. I'm going to convert each of these net present values into an annuity. It sounds fancy, but converting it into an annuity is fairly straightforward. What I do is I take the 192.87 million that I have, 192,870 that I have as a net present value for the first project, and let me state this in calculated terms. That becomes my PV. I have a 3-year life, N becomes 3. My discount rate is 3%, so the R becomes 3%. I look for the payment. The payment that I get is 68,185. A payment of 68,185, a guaranteed payment of 68,185 is equivalent to 192,870. So I've converted my net present value into an annuity. I do the same thing with the second project. I take the 226,697, I make that my present value. This time I enter N as 5, my discount rate is 9%, and I look for the payment. I come up with 58,282. You're saying, what does that mean? If you offered me 58,282 every year for the next 5 years, it's the equivalent of offering me 227,000 today. That's an annuity as well. I can compare annuities, and based on those annuities, I would take project 1 over project 2. But essentially, it's because they have different lives that I have to take this extra step. Finally, a little bit about opportunity cost. When a project uses resources you already own, you got to assess what that's going to cost you as a company. These costs can either be immediate, current opportunity costs, where you can sell something or rent something out, or it can be a future cost, where you run out of capacity sooner rather than later. Sound familiar? So let's take an example. There's a newspaper with revenues of 200,000 and operating income of 40,000. It's considering starting an online edition, which will use up some of their existing server. They have the capacity right now, but if they start this project, you will need a new server in year 2 instead of year 5. So when you think about what the effect of this project is, you're going to have to spend money earlier rather than later. In this case, that's spending money because you're expensing the cost of the server. You're spending 10,000 in year 2 or 10,000 in year 5. You discount them both back to today. The difference in present values is 1,554. Now the reason it was so straightforward here is how the 10,000 was treated as an expense. I'm going to leave you to think about what would have happened if you'd capitalized it. It's not that complicated, right? If I'd capitalized it, I'd spend minus 10,000 in year 2 plus 10,000 in year 5. But I'd also get the depreciation on the 10,000 for years 2, 3, 4, and 5. So you're going to have to compute the tax benefit from it. But effectively, you're looking at the opportunity cost as the difference in cost. So bottom line, if you have a project and I give you side costs or side benefits, your job is to bring it into net present value. Now, I'm not going to ask you any option-related questions because I'm assuming your capacity to use the Black-Scholes is a little shaky right now. So I'll take that into account. No option questions. But there's plenty on this quiz for me to ask you questions on. I hope you found this review session useful, and I will see you at the quiz. Thank you.